Welcome to the Finance Podcast. The topic of this episode, the key to today's fixed income opportunities, with Ariane Den, Gonzague Hachette and Vicky Brown from BNP Paribas Asset Management.
So, thanks a lot for being with us here today. A warm welcome on behalf of BNP Paribas Asset Management. Today we're going to speak about the key to today's fixed income opportunities, right? My name is Tobias Schätzau. I'm heading the client group core in Switzerland at BNP Paribas Asset Management, and I'm joined by two colleagues, Vicky Brown, who is an investment specialist for global ag and absolute return, and Gonzague Hachette, who is an investment specialist for Euro credit, IG and high yield, right? Before going into the topic, I want to briefly share one element which you might not be fully aware of, right? BNP Paribas is in the midst of creating a leading asset management platform in Europe. BNP has bought AXA IM like last year, AXA Investment Manager, and is now integrating that into their platform. And with that, we're going to, as it says here, create one of the largest asset management platforms here in Europe, 1.6 trillion in assets under management. And very important in my view, the majority of the assets, 35%, so roughly 600 billion is going to be in fixed income, right? So that really tells us that we as a firm take that serious. We manage obviously quite a chunk of assets, but more important, I think we always try to have the right, attractive, suiting solutions for you in the current environment, right? And we're going to discuss these two or two of those solutions today, right? So what is the key to today's fixed income investment opportunities? If you look at this chart, I guess you might already get a glimpse of what it is, right? These are different years, different, let's say, sub-asset classes in fixed income. And you see that there's quite some dispersion in terms of performance, right? There's always an asset class, a sub-asset class in fixed income, such as high yield, that performs positive, but there's also other pockets which are challenged, right? And I think the key, obviously, to invest is really to select the right asset classes, the right allocation, and also trying to avoid, let's say, the negative ones to protect the downside from that perspective. And Vicky and Gonzague will introduce you now to two solutions. One's going to be a global solution, and the other one is going to be a European credit-focused solution, which is exactly doing that.
Yeah, so as way of introduction, just going to talk very briefly about the Global Absolute Return Bond Fund. So what's it trying to provide clients with? It seeks to deliver positive performance across a cycle, so both bull and bear markets, and in particular outperform ESTA by 2.5% gross of fees per annum, which we believe is a very attractive risk premium if you compare what you can get through investing in other different traditional fixed income asset classes over time. Secondly, it provides clients with global fixed income exposure within one vehicle. So what can a client expect? They can expect positioning, performance to be derived from different income streams from different parts of the fixed income market. As well as trying to outperform ESTA across a cycle, it's seeking to do that with a focus on capital preservation, so delivering smooth, repeatable performance across time. And we define capital preservation by seeking to limit rolling 12-month drawdowns to be no greater than minus 2.5%. So a very symmetrical return distribution, trying to outperform ESTA by 2.5% and limit rolling 12-month drawdowns to no greater than minus 2.5%. Lastly, it can provide investors with a low correlation to traditional fixed income assets. That could be high yield, it could be EM, it could be sovereign assets as well. So in terms of a solution for clients, it has the added benefit versus other traditional parts of the fixed income market in that it can enhance their diversification if they combine this fund with, for example, a high yield holding. So push their efficient frontier up and to the left. The chart on the bottom helps to illustrate this capital preservation, this smooth performance journey that the vehicle is trying to provide clients with. So what we have here is gross of fees returns for the vehicle if you'd invested since inception, which is June 2021, to the end of January. And we can see there the returns are above 20%. And we've compared that firstly versus the benchmark, in this case, Esther, but also versus a range of different indices. So these are, beta instruments. They're not obviously got an alpha performance to them. But what we can see is that this green line is a lot more smoother than the blue one. So indicating this performance journey that's more repeatable, that's focused on capital preservation. Another point I'd mention here is that the vehicle does actually outperform high yield. That's not an objective of this vehicle. In a strong bull market, it will be very difficult for global absolute return, but not impossible, to outperform high yield. And indeed, in some years, we have outperformed high yield in strong markets. But this vehicle is focused on predominantly IG credit exposure. It's got a low volatility, and it's seeking this a repeatable capital preservation focused journey, which we can see just here.
And then the second fund of the day is the Euro Credit Total Return Fund. It's a fund that we launched in 2015, so that has a bit of a more than 10-year track record with a 5 billion plus of AUM, so a very large fund that has become quite successful over the past few years with investors seeking not only yields, but also the ability of the portfolio manager to maybe get the pickup in alpha, in yields, compared to the market, and protect the portfolio during market drawdown. This fund, Euro Credit Total Return, is a fund which aims to navigate different market environments with a flexible investment approach and with a high conviction investment approach. So I'll break that down quickly for the audience. The first key point about the fund is flexibility. It is not a fund that is managed against a benchmark, and so we won't have investment views that are positioned against a benchmark in terms of overweight or underweight compared to our typical benchmark funds. The investment universe for this fund is Euro Credit, both investment grade and high yield. So flexibility is key in terms of portfolio constructions. The fact that we're not being constrained by a benchmark. Second element is the credit selection that is key. And in a sense, in a way, it derives from the flexibility. This is the ability of the portfolio manager to choose between sectors, across issuers, across the capital structures, which segment has the best risk-return profile. Our investment universe is at the same time large, but quite specific. And so within Euro Credit, which is the basis of our investment universe, we're going to select the segment that we believe have the best risk-return profile. And the idea, again, when I talk about conviction and credit selection, is that we can express our investment views to the fullest because we don't have this benchmark constraints. And then the last point is about risk mitigation and the ability of the fund to use derivative strategies to manage duration risk with future instruments, to manage credit risk with CDS. And this way we can not only mitigate the drawdown, but also potentially derive some alpha from our derivative positioning. On the right-hand side, I've put some of the key characteristics of the funds. The duration has a bandwidth is quite large, from -2 to +6 years. So it's another key characteristic of the fund that shows the flexibility that we have in rate space as well. I mentioned earlier that the investment universe is Euro Credit investment grade and high yield. We can invest up to 49% into high yield. This is the prospectus limit. Typically, high yield allocation in average since inception has been around 30%, so we don't tend to go up to 49. The rule of thumb is that the fund at all time needs to maintain an investment grade profile, so BBB minus at the very minimum. At the moment, this is a BBB plus credit quality that we have in the portfolio. Annual volatility is 10% maximum, but again, we don't intend to use that up to its maximum. As you can see with an SRI risk that is 2 out of 7, so quite limited. And then in portfolio allocation, you have a flavor of the current allocation that tells you some element about the instruments that we use, that we invest into within the investment universe. Obviously, we're quite not shy. We're not shy to invest into what we call the aggressive segment of the market, which is composed of corporate hybrids, financial subordinated, and pure corporate high yield names. I'll pause there.
Thank you, Gozank and Vicky. Now that you introduced, let's say, the two strategies, right? I mean, how do you achieve both performance and downside protection? How do you use the flexibility within that portfolio? And what are the, let's say, the key alpha drivers in the two strategies, please?
Yeah, so for global absolute return bond, in terms of delivering against that target of 2.5% gross of fees versus Esther, firstly, it's about taking an appropriate amount of risk relative to our view, but enough risk to deliver against the objectives. And by enough risk, I mean, typically speaking, per annum, it'd be taking around 3 to 4% tracking error contribution. Because risk budget-wise, that's what we believe will, over time, deliver the objective, which the fund has done very strongly since inception. Secondly, it's about identifying and investing in those strategies that have very strong asymmetry. So very limited downside and decent upside. And that's based on, obviously, the valuations and where that position is trading and the entry level that we get into that position within. So we're always seeking to invest in positions with strong asymmetry. Right now, for example, that would be a long to the New Zealand curve in the front and the belly, where we think hikes are prematurely priced. In terms of delivering the capital preservation, limiting those rolling 12-month drawdowns, we have 4 key elements of the process that help us to do that. Firstly, we use strategy tagging. So every strategy position that we have in the product, we will tag that in our risk system, which is BlackRock's Aladdin risk system. And this allows us to compare each strategy by apples. So we're looking and monitoring the risk performance on a strategy level. That helps, again, identify asymmetry and better manage the fund, and means we can provide clients with that information too. Secondly, we use rigorous scenario analysis. So we test our vehicle continuously across both our base case view and 3 to 4 hypothetical possible risk cases as well. This allows us to better understand risk, understand the correlations between different strategies, and ultimately build a portfolio that not only performs very well in a base case, but can perform well across a range of different scenarios. So build a book that can deliver a flatter performance distribution over time. Because again, we think that is key to capital preservation. We also have soft sector and strategy limits. So you won't find these in the prospectus. But these limits are on desk, and what we say is that we try to keep sector risk to no more than 50% standalone risk as a percentage of stacked risk. So we don't want risk concentrated in just interest rates or EM or structured securities. We want a well-balanced portfolio. At the strategy level, we keep the standalone risk within one strategy to no more than 1%. Again, it helps to limit that downside from any one position and build a diversified book. Lastly, we use stop losses across market-sensitive positions where we deem they're particularly relevant, but we don't arbitrarily apply stop losses across all strategies. The reason for that is philosophically, we do not believe that doing it is the best way to manage money for the clients, because if we look back to Liberation Day, April last year, if we'd have applied stop losses across the whole strategies across the book, what we'd actually end up doing is closing positions in a volatile market at prices we don't want, which left us with an unbalanced book. So selective use of stop losses only in those positions that we deem most relevant.
And on Euro credit total return, it's a bit different. We don't have a specific investment objective in terms of alpha target. One element I can give you is the annual gross return since inception, which is 5.20%. That gives you an idea of what the fund has been able to achieve since inception. And then every year, with the investment team, we just try to do this rigorous exercise to try to sort of estimate what would be the potential performance or alpha target we could achieve this year. There's different components that we could look at, and the first one is carry, which is probably the core return element, which is just the return that you earn by just holding the bonds. The Euro credit IG market delivers about 3% as of now, 5% for high yield. If you consider a portfolio with a 70% investment grade, 30% high yield allocation, that gives you a carry of about 3.6%. And then I think this is a starting point for us. And obviously, as active portfolio managers, we want to achieve much more than that. It's not even I would not even call it the minimum, but the starting basis point, the starting point. Then there are other elements to consider to build up performance, roll down and duration, which is probably not going to deliver a lot this year. Roll down not so much because we consider that the credit curve is rather flat or not very steep. From a duration perspective, in terms of the ECB monetary policy, there's not much to expect there. So holding duration passively does not provide you a lot. But we do have other active drivers of performance that can add up. And this is the credit selection, the high conviction I mentioned earlier, the preference for financials over corporate, for example, within corporate, the preference for defensive sectors over cyclicals, the preference for subordinated bonds over senior bonds. So all of that is going to help us achieve some addition basis point of outperformance. And then the duration management, taking advantage of rate volatility, or even like the CDS protection to limit the drawdown if we expect some spread widening. All of that could contribute to not only protect the portfolio, but also achieve a bit more of total return. I'll leave my answer there. I won't come up with a final figure in terms of performance, but I would say probably that we hope to achieve something that would be similar to what we have achieved last year in 2025.
Excellent, thank you. And let's dig a bit deeper into the portfolios, right? How do you guys select or identify and select your best ideas in the global fixed income universe or in the Euro credit universe? How does that really work, right?
Yeah, so global absolute return is very much exploiting an unconstrained universe, so very free. We invest in developed market interest rates, we invest in structured securities, so agency, non-agency, backed MBS, ABS. We invest in EM, could be local or hard currency, could be corporate credit. Developed market corporate credit, where we can invest up to 60% in high yield, but typically speaking, exposure's not gone much above 15% since inception because of the valuation backdrop behind it. And then a little bit of FX, but it is predominantly a bond fund at heart. FX is used for diversification or where we have a particularly high conviction view. So how do we exploit such a large universe? It involves deep collaboration and partnership with the different teams we have within the platform. So at BNP, we have significant resources covering all public sectors within the fixed income market. So the way that we utilise and leverage their ideas begins with our macro research team, so our bunch of 6 economists who specialise in region. Now, they provide their base case view and their risk cases on a Monday meeting, which we can all participate in, listen to their views, and then they also feed information regularly throughout the day and week as well. These base case and risk cases feed into our Global Investment Committee, which is a monthly meeting that Global Absolute Return and Ag Team chair. We lead the direction of it. And the main objective of this meeting is for each of the heads of the desk within the platform, so for example, Ala, who covers emerging market debt, to provide her forward-looking views on her sector. And she does this by providing a view using a scale of +2 to -2 and indicating a level of conviction around it. It could be high, low, or medium. And it's not a paint-by-numbers approach where we take a +1 score on structured securities and make that mean a particular size in the portfolio, because there's a whole host of different factors we need to consider to position ourselves within the fund relative to that sector and that position. So a list of factors we need to consider alongside it. But 80-90% of the time, the key views that come out the Global Investment Committee will direct the strategy positioning and provide a deep framework from which we take our view. So the portfolio will, roughly speaking, align with the direction of the investment committee. Another means we access the ideas of the platform are through single strategy team meetings. So these are either weekly or bi-weekly meetings that we have with each of the separate teams. So we have one with credit, we have one with structured securities, etc. And this allows us to have a really granular deep dive into each of the areas. So 2 prime sources alongside on the desk communication in London. We have high yield, FX, EM, IG portfolio managers that are on the desks adjacent to us. So we also can uncover their ideas through simply, getting up and talking to them and having on the desk discussions. So this is the main way that we seek to really identify the ideas that the platform believes offer the most asymmetry, which then provides guidance and framework for this portfolio and the other books that we manage in multi-sector fixed income as well.
And on Euro credit total return, I mentioned earlier that selection is key, and in order to understand how we do that, it goes back to the investment team. So there's essentially 3 key points I'd like to highlight about the investment team. The first one is that we operate on a one-team approach where this investment team composed of 9 investment professionals combine both investment grade and high yield. We have 2 high yield PM, Eve and Chris, based in London, and the rest of the portfolio managers are based in Paris and cover investment grade. The fact that this is one single team allows us to benefit a lot from the insight of the high yield portfolio managers. So in practice, we have this daily morning call, 10 a.m. every day, where PMs and credit analysts discuss about high yield issuers, prime markets, corporate actions, whatever, earnings. And it helps us, I would say, a lot on the investment grade side, because this portfolio, Euro credit total return, is an investment grade portfolio which does invest into high yield. We benefit a lot from the insight of the high yield team. Maybe this is less the case for Eve and Chris because they typically only manage pure high yield portfolios. But for us, we're going to benefit from their insight on the high yield investment universe. Second point is about the PMA model that we operate on. PMA stands for Portfolio Manager Analyst. So our portfolio managers have this dual hat where they're not only portfolio managers, but also analysts. They do have a sector oversight. We have a dedicated credit research team who perform purely fundamental credit analysis. And then the PM, as PMA, they're going to perform the relative value analysis. They're going to host and conduct the relative value sector analysis every week. So they know inside out their sectors, and they bring this expertise to the table and to the rest of the investment team. So Butaina, for instance, responsible of real estate and then retail sectors, Adil utilities, Mathieu financials, and so on and so forth. And then the third point is about the team-based approach that we have, where investment ideas are being discussed informally at the desk, formally on a weekly basis during investment team meetings. They PM exchange investment ideas. Every single PM leads its sector discussions, and we achieve investment views as a whole, as a team, investment views that is then being implemented across the portfolios. So typically when we have a view on the financials and we are long financials, this is something you're going reflected in all portfolios, including this one. So we can literally work all collaboratively and get the input of every single portfolio managers into this product. So this is Butaina managing this product, but she gets the insight of everyone in the team.
Great. Here it says stress testing, downside control, flexibility. What's the playbook? I kind of like that, but maybe ask differently. How is, let's say, the unconstrained approach, the flexible approach you're both using, right? How is that leading to better performance compared to peers, etc. Right?
Yeah. So first thing I'd say is that we do use scenario analysis. We've outlined that earlier on, but we don't tend to use historical scenarios. So we don't think it's particularly relevant to stress global absolute return bond in a GFC environment. We don't think it's going to happen again. We think it's much more relevant to create hypothetical cases that we believe are more relevant. How do we do that? So it begins with that macroeconomic team I mentioned on the prior slide. So they work independently to us. They provide us with their base case view and 3 to 4 possible risk cases. They generally change these risk cases every 3 months, or as the market changes, and our view warrants needing to adjust these as well. These risk case and baselines are then passed through to our fixed income strategist called Mikhail, who works across the platform but focuses a lot on our product. And Mikhail effectively stresses a range of assets, so there's about 16 different assets. He stresses those based on his own experience, expertise within fixed income, to come up with a number that he thinks is a probable move in each of these scenarios. And that's then fed into Aladdin, which then provides the output we have here. So what we are seeing is portfolio performance, hypothetical performance, as of the portfolio we have today in each of these possible risk cases. And we want this information because it allows us to better understand how the fund can perform across a range of different scenarios. And going back to what I said at the beginning, where we're seeking to deliver a book that has a flatter... Oh no, it's gone.
You lost the slides, please.
We are concerned that valuations are historical lows, which is why we actually have a short to USIG credit in the fund. So we're not long credit. We think it's got great asymmetry because there's very little downside risk at the moment in USIG. We actually put that on in January, and it's added to performance, year to date, because we've seen a little bit more pressure within that market. Within sovereigns, we do like duration, but it's selective duration. And that selective duration is favouring New Zealand curve, where they're pricing in around 100 bips, just less than that, of hikes. And we think that central bank is on hold, given labour market is pretty much on its knees. There's a negative output gap, very weak growth. We also favour UK, real yields, inflation-linked gilts, where again, it's very isometric. There's not many cuts priced in, but the UK is in a similar position to New Zealand, weak labour market, sanguine growth. And then we favour duration in positive carry markets like Brazil. So selective use of duration, we don't blanket like duration everywhere, and we don't favour credit here. Maybe I'll just finish this slide and then hand it. Yes, so the bar chart shows the possible performance in the 4 different risk cases. And the real benefit of doing this is we can see how the fund can perform across different conditions and better understand the underlying strategies that are driving these numbers as well, and the correlations, how those correlations between the strategies are working together to deliver this. And the ultimate aim is to provide a fund, to deliver a fund that doesn't have exceeding performance in just one base case scenario. Instead, it can perform okay or better across a range of assets and not disastrous in what would be a worst case scenario, because that goes back to this capital preservation focus that the fund is seeking to deliver.
And on Euro credit total return, I think the key is about flexibility, and going back to one of the key characteristics I mentioned earlier, and how we are flexible by managing duration and managing credit risk with CDS. So the first example is on duration. You have a chart at the top hand side which shows the natural duration of a cash bond, so 70% IG to 30% high yield on average. So that gives you a duration that is in between 4 and 5 years. And then on the chart on the bottom hand side, you have the duration of the portfolio, so cash bond plus the derivative instruments. So we're going to use most of the time interest rates on the German sovereign curve. And so you can see that we're much more active through times. I think 2025, the duration has ranged in between 4 and 5, but it was quite active. Sometimes we don't feel how active the fund is, and we need to obviously look and zoom into specific months to show and to see the activity of the funds, because we manage duration on a day-to-day basis. But this is a way for us to protect the portfolio or even potentially deliver some positive total return. Last year, about a third of performance was accounted for, was coming from duration management. And then on the second slide, you have the other type of flexibility managing credit risks with CDS. So before talking about CDS, let's have a look at the high yield allocation, which I mentioned is about 30% on average. Right now, slightly below historical average at around 28%. And in terms of CDS, we typically, most of the time, not always, but most of the time, we're going to use iTraxx crossover in terms of CDS positioning, which is a proxy for high yield. So it's a way for us to actively manage the high yield pocket without necessarily buying and selling, which would generate a lot of turnover and a lot of expenses in the portfolio. So we're going to use those CDS instruments to implement more tactical view. Typically the high yield allocation is coming from a bottom-up allocation into high yield, believing into the fundamentals of the bonds we invest into. And then when we want to manage the credit beta, we're going to use more liquid type of instruments like CDS or cheaper in terms of a trading cost, and that we can keep in the portfolio just for a short period of time.
Now, looking a bit into performance, right? In 2022, beginning of the year, we've seen quite some rate rise shocks, right? Within a couple of weeks, the fixed income asset class has been challenged big time, was in negative territory. Both strategies actually achieved great results in that period. How did you position your portfolio? How did you achieve that?
Yeah, so if we firstly look at the return delivery over 2022, so the fund delivered 1.2% gross of fees, and it delivered the same excess return actually versus Esther. So a strong return delivery in what was a very difficult market. In terms of two key things that we did within the fund to help to manage the risk, deliver those returns. The first thing is that we removed duration where we didn't like it, where we felt that we weren't paid for taking that risk. So a prime example is we started 2022 with an allocation to credit, which was a pocket managed by a credit team internally for us. So we got both duration and spread risk through that sleeve. We actually decided in the first half of the year to hedge out the rates risk, leaving us with just access to the spreads. So I think actually if we go to the next slide, we can see this. Yeah, so you can see here blue bars indicating duration risk from IG credit, and then we started to slowly hedge the risk out, and then hedged it all out, meaning we got rid of that duration risk from IG. Effectively, the hedging of the duration did add to performance. The spreads, unfortunately, over the year that didn't, because spreads blew out, but the hedging worked for us. Second to that, this product is very flexible. So duration range is -4 to +4. And as we can see through this slide, over time we have used that ability. So clients can expect us to really move this duration about in the book. This benefited us in 2022. So in November, our base case was very much that there was a risk of over-tightening by central banks. And in a very rare situation, the risk case is actually aligned with that base case. So both base and risk cases were pointing in the same direction. They were both showing the possibility of over-tightening by central banks. So we decided to we set up a short duration stance to both the US and the Europe in the book, and that strongly added to performance. We closed that out in 2023. So their key things will not only indicate the flexibility within the product, but two key ways that the fund can deliver in ways that more traditional fixed income assets can't in a difficult backdrop such as 2022.
And on Euro credit total return, the fund delivered a negative 3.5%, 3.57 on a net basis. It was a challenging year, as you said, Vicky, for the entire market. Because the fund is not an absolute return bond fund, it doesn't have the same capacity to resist and to absorb market shocks. What happened is that everyone who was long credit suffered because of spread widening on the back of recession fears, the war in Ukraine, and the uncertainty of the path of ECB monetary policy, which did eventually rose rates in summer 2022. And then everyone who was long duration also suffered because of the rate moves. On our side, we were long credit. We had about 45% invested into high yield, close to the maximum appetite. How do we react? We actually we hold our position, and we even actually added even more credit risk through CDS by actually increasing the level of the credit risk with with CDS, so selling protection, which eventually did pay, and we could offset partially some of the loss. And then in terms of duration, we were lucky enough to be like have a small long position, so we were not too much hit by basically the market moves in 2022. But that was quite aggressive. If we split, the year, the first half of the year was a negative 10-11% in the fund, and then the second half was a plus 10%, plus 9% in the fund, which resulted into a negative 3%.
Thanks. So it feels like the macro regime or the market environment is changing constantly, right? If you look in 2025, at the beginning of the year, we had a new old guy in charge. We changed, let's say, the mindset quite a bit. Where did you find, let's say, opportunities for your two strategies in that period?
Yeah. So in 2025. We can actually move to the next slide, if that's okay. Yeah, great, thank you. And we began 2025 in quite a defensive position, and part of a key theme that we had in the fund was we were fading US exceptionalism. We felt that too much good news was priced into risk assets, and too much positive US growth. So we began to fade that. We had a short to the US dollar versus currencies such as yen. We had a long to US real yields. It's a more defensive way of being long duration, more defensive than nominal bonds. And we had a short to US IG credit and European high yield, which is what we can see on this chart here. And we can see these negative blue bars over the beginning of 2025. And at the start of the year, that positioning wasn't particularly playing out. But then we had Liberation Day in April. And, the market got shocked, risk assets got spooked, credit moved significantly wider. Spreads on USIG, Euro High Yield moved around to 70% to where we expected them to go. And so we took that as an opportunity to monetize the position. So we outright closed those positions, which is why we can see no blue bars between March and sort of September time. So that added about 70 bips to the fund. That Liberation Day experience as well, we use that as an opportunity to tactically buy into positions that we believed had strong asymmetry and offered opportunities. So an example is the Australian curve significantly rallied. So in late April, we actually set up a short to the front end of the Australian curve. We closed that in May. That benefited performance. And we also initiated an Australian flattener because we saw significant steepening, selling of the back end of the Australian curve. So we're quite tactical around that Liberation Day experience. If we turn to the next slide, we can look at overall risk. So this shows portfolio tracking error contribution. So it includes the diversification. It accounts for diversification between different sectors and strategies. And a key point to mention here is that in 2025, risk was one of the highest in the summer. And we then made a concerted effort to bring this risk down, which is what we can see in this chart. So in around September time, October, ahead of year end, we'd had very strong performance over the year, and we wanted to protect some of that performance. So we reduced overall risk in positions that had performed well, and also ones that we believe were a little bit more market sensitive, such as Colombia and Brazil. And in the final quarter, unfortunately, we did have a few positions which didn't play ball. We saw a few idiosyncratic movements, for example, in Colombia. But the fact that we'd actively reduced risk ahead of year end helped to somewhat offset some of these losses. So again, the dynamic nature of this fund, the fact that we aren't going to be sat at a certain risk level, we're going to move that book around, has helped to navigate those movements over 2025.
And on the Euro credit total return, I've decided to show a bit of a longer period because I believe that some of the trends and the theme are a bit similar between 2023, 2024, and 2025, where the fund delivered outstanding performance pretty much in line with what the European high yield market has delivered. And for us, it's really about yield and spread compression. We have been over the past few years in an environment where yields were above historical average, and this has helped us a lot, obviously, to take advantage of that carry element. The spread tightening move that we have observed over the past 3 years, did also support us in terms of performance. Obviously, there were different reason for spread tightening, the fight against inflation, then the resilience of the economy, then the risk premium, with the ECB having reduced their policy rates being reflected in the spread. And so every single year, what we have observed in that, from a market beta perspective, the spread has tightened overall. There's obviously some idiosyncratic stories at the sector level, at the issuer level, and we managed to obviously stay away from some of the sectors, like chemical that we don't like too much. But overall, we benefited from the massive spread move that was observed in the markets, and we had this strong long position into what the high beta segment that is being reflected with corporate hybrids, financial sub, and this has helped us to deliver this strong performance over the past few years.
Great, thank you both. And maybe we can conclude, let's say, briefly with your view on the current market environment and the outlook positioning.
Yep. So overall, we are defensively positioned. So we have tracking error contribution that's around 60 to 70% of the target. So around 300, 350 bips of risk there. And we have a long duration bias, so around 3-year duration at the fund level. Most of that is held through developed markets space. Some of the key themes we have within the fund. So firstly, we do believe and expect US growth to be softer than market consensus. So we're not calling for a hard recession here. What we're saying is we think US growth will probably be slightly below trend, so slightly below 2%. And we do also expect weaker labour markets. We have seen the labour market soften over the past 12 months, particularly the last 6 to 8 months in particular. But we do expect employers in the US to continue to, for example, reduce their hiring, absorb the higher costs that they've incurred for tariffs through reducing the labour costs. And ultimately, we think this will enable the Fed to cut a few times from here. We're positioned for that in a few ways. We have a short to the dollar versus the yen. It's not a significant position. We also have a US curve steepener on. And then we have the short to US IG credit that in a weaker growth backdrop should see credit spreads wobble and widen. Next theme is investing in the parts of the duration market where there's strong asymmetry. So we answered this before. It was the answer to the question, really, but here, select DM markets, New Zealand, UK, Japan, where we've bought into the long end in January with the movements we saw there. In EM, favouring, for example, Brazil or Czech Republic. A next key theme is we've been fading the carry. So a key story that's been in the market year to date is January in particular saw a real bid for carry. So EMFX positioning there was getting very stretched, people buying into it. As well, credit, we saw further tightening in January. Equities continued to rally overall. Now, we've been fading this theme through. We initiated a short to EMFX versus the dollar, where we think it's a very crowded trade, and we're likely to see some weakness there. And then we initiated this US IG credit short as well. The last key theme is exploiting valuations in Japan. So Japan has had a lot of noise year to date and last year with a change in government and the fiscal easing that PM is bringing into Japan. Alongside that, the Bank of Japan has been hiking rates at a very slow rate. We've been buying into the theme through the curve. So we've bought the long end of Japan. We bought that in January. That position's performed very well, and we still hold it because ultimately we think demand should pick up from here for that market. And then we've also been playing it through a long to yen, which is an equivalent way of effectively being long duration within the Japanese market.
Thank you, Gonzag.
And on euro credit, I'll talk briefly about 3 points. Valuations, it's a bit of a mixed views. This is attractive from a pure yield perspective, above historical average. If you look at the past 10 years, spreads are rich. They are tight. There's not much value to expect, not much spread tightening potential. The comfort is that basically we believe that the carry that the yield provide would compensate if we could observe some short-term spread widening, which is not even our best case. We believe that we don't see any catalyst in the medium term for spread to widen. So spreads are rich, but the yields, the attractiveness of yields justify to be invested into credit in our perspective. Fundamental is resilient, and we've seen quarter after quarters companies posting surprisingly positive result, especially on the financial side. We are even more positive from a purely fundamental perspective. And then the technicals is really where we hold the plus and technicals, which does represent the balance between supply and demand, are positive in the sense that we continue to see inflows coming into the asset class. The demand is expected for 2026 to be at similar level compared to 2025. The supply, will be at similar level, and the demand should continue to come in. And it was an interesting point to something we've seen last year: flows coming continuously into the asset class, which did support the spread to remain at the tight level. So for that reason, we hold the following position. We are long duration. It's not so much a view on rates specifically, but it's more also that duration acts as an edge against credit. We like so much credit, but at the same time, we want to protect the portfolio. If there was spread to widen, we could expect a flight to quality move and duration to provide a bit of protection. We long credit IG, we long high yield as well, with about 30%, 28% at the moment. And we are long corporate hybrids and financial sub, which is the high beta segment that we like at the moment in the markets.
Thank you very much, both of you, right? I mean, I know we're a bit above our time allocation, but if there are questions, feel free. The floor is yours. Yeah.
One quick one, what's the max short of the percentage of the portfolio?
Yeah, the main, do you mean in terms of credit, the max short we'd look at it in sort of DTS units really is the best way to measure the credit risk. And historically, the max short's been about what it is now, -3%. We can go bigger than that. We've talked about actually upping it to about -5. We haven't done it yet, but I think if we start to see a bit more weakness in US labour markets, or we've seen more indicators in terms of US growth be a bit not so good, right? We saw retail sales get revised October, November, December it was contraction, negative retail sales print. So I think if we get more of that and we get a few sort of scares in equities or private credit markets, we might up that position in credit. From a duration point of view, we obviously have a hard limit of -4, so we can't go above that. But again, there's been times where we've been pushing that on that door. So yeah.
And on the euro credit total return, duration would be -2 + 6 years. And then on credit, we don't have like a spread duration limit so much. What I've seen in the past is more the spread duration. The minimum level has always been positive. So we have never been like negative credit with a negative spread duration. It wouldn't be so much the philosophy of the product. So we would remain in positive territory, and we would try to find out the segment of the market that would have the best risk return potential. So this aggressive, a segment, it has been the lowest that I've seen since inception is 20%. This is how we would protect the portfolio by reducing significantly the aggressive allocation to the aggressive segment and trying to bring up some protection with CDS.
Okay, I suggest we conclude here. Thanks a lot for being with us today, right? Thanks a lot, Gonzag. Thanks a lot, Vicky, for sharing all your insights. I think we believe that the key to today's fixed income opportunity is really flexibility, is an unconstrained approach. We have seen two attractive solutions, in my view, a global and Euro credit focused solutions. There's further information next to Gonzague in case you're interested on the two portfolios. But again, thanks a lot for being with us today, and enjoy the Finanz 26.
Thank you.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory. New episodes are released every Tuesday and Thursday.